Hello, Mark Lowerdy here. If you're a CapitaLand shareholder, here are 2 reasons why you should read this document, the 2012 Annual Report. Reason number 1 is that the annual general meeting is on the 26th of April, and you need to know what's in this document before you go. But reason number 2 is that it's not just a reflection of the 2012 financial year. It is also full of forward-looking statements that help you as an investor determine whether to stay invested in this company. Now, in the next couple of minutes, I'm going to go through some of those points that are made in the annual report, but that's of course no excuse for you not to read it for yourself. First of all, let's take a look at the strategic business units that CapitaLand is organized into, and it reorganized into 4 during the financial year. This is the CapitaLand Singapore page, color-coded green, which gives you an idea of how the last 12 months have performed and the key executives. CapitaLand China is color-coded in pink, with some future prospects also being noted over here. Here is the page for CapitaLand's Asia, the strategic business unit encompassing all of their retail malls. Once again, some commentary on mall openings. They're going to open 2 in Singapore in 2013, 3 in Chengdu in China, including one part of the malls, which phase 1 of which has already been opened, and 1 in India. So, as I said, forward-looking commentary that'll help you understand how 2013 is shaping up. The 4th strategic business unit is color-coded purple. That's the Ascot, the serviced residences business, and you can see here that they're looking to achieve a 40,000 apartment target by 2015. In fact, elsewhere in the annual report, you'll find mention that they're looking to launch 10 additional properties with 1,600 units during 2013. Now, let's get down to how these business units perform relative to each other. And what we have here on page 91 of the annual report is the 2011 pie chart compared to the most recent year under review, 2012. Now, the first thing to note is this revenue figure up here. The total revenue has gone from 3 billion to 3.3 billion. So this pie chart, or this pie, is actually 10% bigger than it was in 2011. What we see here is that CapitaLand Residential Singapore, color-coded green again, has stayed much the same at 25%. So a quarter of their revenue comes from residential properties in Singapore. Australia, though, through Australand, has grown from 27.5% to 34%. So from about a quarter to more than a third. So the Australand business is contributing much more than it did in the previous year. China's contribution, though, has shrunk from 17% to 12%. And here that orange sliver, once again, that's CapitaLand's Asia. That's the retail malls business has grown from 8% to more than 10.5%. We see a similar picture reflected in the breakdown by geography, by geographical location. This is page 95. If you've got the document in front of you, you can turn to page 95 and see these for yourself. Singapore contributes still about 1/3 of revenue, but where China previously contributed about 1/5, that's gone down to about 1/6, or in other words, 22% down to 18%. And Australia, marked here in blue, previously contributed less than 30%, now in 2012 actually contributed slightly more than their home market of Singapore. So Australia still going strong, China easing off. Details as to why coming up, stay tuned. First though, I wanted to take you through this set of numbers here on page 4 of the annual report. It's the 5-year financial summary. And what you can see here is a whole lot of numbers that I'm about to take you through. First, the revenue numbers showing that in 2012, that $3.3 billion figure that I was referring to earlier, up from $3 billion last year. 2012's number is not as high as the restated 2010 figure, but it is significantly ahead of the $2.75 billion back in 2008. Similarly, on the assets side, CapitaLand has never been bigger, with a almost $38 billion dollars in assets, up about 50% over the 2008 number, the biggest it's ever been. But on the profit number, This set of numbers here, the bottom line as it were, it's at 930 million, and that is a decline over last year's number of more than $1 billion. In fact, in the last 5 years, it's the first time that their profit is less than $1 billion. And I'll talk to you about the reasons in just a few moments as well. You see, the profit after tax and minority interest on an operating basis was actually better than 2011, but there weren't as many portfolio gains or revaluation gains. And as a result, this final bar here on the right couldn't reach up to the $1 billion mark. That's the reason why profit fell. It is not that the business isn't performing on an operating basis, it is that the accountants who are going through the books and doing the portfolio evaluations and re-evaluations of properties didn't find sufficient increases in those valuations. Now, let's take a look at some other important financial ratios, and you'll find these once again on page 4 of the annual report. First note of interest is the interest cover. That is, how many times over can they service the interest on their debts? And the answer is 5.5 times. That's not as high as in previous years, that is the last 2 years, but higher than in 2008 and 2009. We also have numbers up here, net tangible assets per share. What this number here tells you is the value per share every time you buy the stock, $3.44. So this is not what the stock is currently trading at on the market. It is telling you what the stock is actually worth. And the other interesting number here is the dividend number. There are 2 lines. And what you see is that last year they paid 8 cents, in 2009 even 10.5 cents. Now that's more than the 7 cents paid in 2012. But don't forget, this is the ordinary share number. And that's grown consistently from 5.5 to 6 cents, and 6 cents again in 2011, up to 7 cents. So even though the total dividend in 2012 was not as high as in 2011, the ordinary dividend is higher. And usually management of companies only increases the ordinary dividend when they're confident that they're able to sustain it. Let's have a look at the debts, and what this bar chart shows you, once again from the annual report, is when the debt is due. 800 million in the next year, 1.6 billion in 2 years, and 2.4 billion in 3 years. They owe this debt to the banks. In part, this is where the bank borrowings are listed, and you can see bank borrowings have grown. But what's really noteworthy is that they have far more unsecured loans than secured loans. And they total 7.4 billion, up from 6.5 in 2011. 7.4 billion, hang on to that number, because we're about to get to the cash holdings number. And that is that they have about 5.4 billion, almost 5.5 billion in cash. So they have more debt than they have cash, but they also have substantially more assets. The cash number, incidentally, is down from 6.3 to 5.5 billion, and we find the answers as to why here in the cash flow statement. Cash from operations, cash from investing, cash from financing. Cash flow from operations was $250 million. So the business itself is actually throwing off cash. They did reinvest a lot of money into their business through, for example, associate companies and joint ventures. They bought property of almost $900 million. And so they're reinvesting in the business to the tune of 1.8, almost $1.9 billion. The bottom line of the cash movements, therefore, is what we saw just now, down from 6.3 or so down to $5.5 billion. But at least the company is generating quite a substantial amount of cash. Now, at the AGM, this topic is bound to come up for discussion. It usually does at most companies' annual general meetings, and that is, how much are the directors getting paid? What's noteworthy about the CapitaLand annual report is that they don't just give bands, that is, ranges of funds or figures that the directors are getting paid. In the CapitaLand corporate governance report, it actually spells it out down to the dollar for each individual director. If this is something that interests you, you can find this information in the annual report. And that brings me finally to the letter to shareholders. Now here we see the new chief executive. He's been in the job now since Liu Manliong retired back in January. He is Mr. Lim Ming Yan. It is his first appearance here in this letter to shareholders as President and Chief Executive of the company, standing here next to the Chairman, Mr. Ng. But this letter is again very interesting because it is not just a commentary on how the last 12 months have gone or some nice sounding words. It is full of substance, including over here the fact that the company has changed its Chinese name, has simplified it or streamlined it, as they say, to Kai De Ji Tuan, and you'll find that over here in the letter to shareholders. Here on page 2 of this letter, there are also some very important nuggets for current shareholders to get an idea of how the business is performing and what the future holds. I want to zoom in on this part in particular, which tells you where they're going to sell more units. Deleden, that development, as well as the Interlace, is where they're going to progressively release new phases. They also have a freehold 150-unit condominium on the East Coast up for sale, and a second Bishan site, subject to market conditions, will also be put on the market. All of this in 2013. So that should give you some idea where the action is going to be for CapitaLand in the year ahead. Over here, we can see some further commentary on China. And so what you heard earlier on in my report is that China has been falling as a proportion of its contribution to the overall revenue. And here is why. It says that CapitaLand handed over about 2,000 units, 1,995 to homeowners in 2012, and that this is a 40% decline compared to 2011. At the same time, 28,000 homes are yet to come on stream during the year. They also have a new site in Shanghai. So all up, China not performing so well, but plenty of homes still in the pipeline there. You'll find that in the letter to shareholders, as you will this next piece of information. And here I'll zoom in on how their malls are performing and going. The group currently has a portfolio of 8 Raffle City projects, and the Chengdu project is slated to be fully operational by the end of 2013. So once again, if you're interested in the malls part, this is the section of the annual report where you will get some idea of how things are shaping up. I want to zoom across now to this part of the annual report where we get to hear about the full year contributions that we're going to get in 2013 from the Star Vista, where the annual meeting is actually being held, JQ, Bugis Plus, and the Atrium at Orchard, as well as their plans to open 6 malls in 2013. You'll find all of the details here in the letter to the shareholders as to where those 6 malls are. Here's a hint, it's not all in Singapore. Over here, we get to see more details about the serviced residence business, which I mentioned earlier. And I hinted at this before, that they're looking at opening 10 more properties with 1,600 apartment units in China and Indonesia in 2013. This is where the growth is going to come from. And we're thankful to get these forward-looking comments in the letter to shareholders. Just a couple more points to make, and that is some of the parts of the business that are under review. The Australand stake of 59.3% is undergoing a strategic review with a view to optimizing shareholder value. So we might get some news on that during 2013. The group is also currently reviewing Japan and Vietnam, although it's looking to keep those in the group. UK, India, and the Gulf Cooperation Council parts of the business are also currently undergoing a review with a view to having some answers for shareholders in the coming year. So once again, we're going to see some action on their geographic diversification. And last but not least, this is the final page that I'll refer to in the letter to shareholders, and it gives you an idea of where they see the economic growth, 1 to 3% in Singapore, 7.5% in China, and how they are going to capitalize on that. Now, before I go, I also want to show you this page. It's the Environment, Health and Safety page. Now, why is this important? Because it's part of the sustainability report in the annual report. And this is something that the Singapore Exchange is placing increasing emphasis on. It's looking to more companies to disclose how they are becoming more sustainable. And this is something, again, that you'll find in more and more annual reports, because Internationally, investors are increasingly interested in this sort of information. You might be too. The details are in this document, the 2012 Annual Report from CapitaLand.